Hey everybody, it's Ryan Speltz, and today on Ryan Speltz Presents, we've got Matt Krager with Outfast Realty and Investments. He specializes in investment properties and helping other investors find different types of investment opportunities. So Matt, I'll let you introduce yourself, and then we'll get into our topic of the day.
All right, thanks, Ryan. Like Ryan said, I am a real estate agent. I've been a real estate agent here in the St. Pete, Pinellas County area for 12 plus years. Recently moved, by recently, about 3 years ago, moved over to Outfast Realty and Investments because they put a huge focus on investments and, kind of creating your own wealth through investments and buying. So I went over there and just been learning from there ever since. It's been a great experience, and thanks for having me on.
No problem. So you mentioned that you're focused on the investors. What are your investors talking about? Like, are there any specific things that they're bringing up that you've got questions on to kind of get out there and help them on the, from the mortgage side, obviously, that I can bring? What are your investors talking about? What are they looking at right now?
Yeah, so I mean, one of the main things that we're seeing and that I'm seeing is that if you are new to the investing side, there's a lot of times that these the hard money lenders, they're not going to work with you, and if they do work with you, they're absolutely going to kill you on fees and interest rates and things like that. So if you're a new real estate investor, trying to get that first start could be hard. And I think that's one of the good things we're going to be able to talk about today is one of the loans that'll help these new investors be able to acquire property.
For sure. Yeah. And then, the DSCR loan is one of those that we have been utilizing at a high level, where we're at and being able to get out there and help a lot of different investors that wouldn't have been able to buy about 3 or 4 years ago, that where this product just wasn't feasible.
Yeah,
And
and
so,
yeah, I know. For me and you, kind of being in the business, we'll throw around the acronyms and a lot of these uh, abbreviations for the things we're talking about. But a lot of people don't know what the DSCR loan is. So what exactly can you tell them what that means?
yeah, caught me there. Definitely use the industry jargon a little too much sometimes, right? We throw out these acronyms, like you said, and DSCR is definitely one of them. So DSCR stands for Debt Service Coverage Ratio. And of course, now I just went from an acronym to more mortgage jargon, right? So debt service coverage ratio, to explain that a little bit better, essentially it is what the home will rent for divided by the mortgage payment. Okay. So what that means is, like, you're going to go out and you're going to find a home, and when you get it appraised, the appraiser is going to do what's called a rent schedule on the appraisal. And what that does is it gives you an outlook as to what the market rent for a home like that in that area would be. And so you're going to utilize that number and then divide it by what your total mortgage payment is. So principal, interest, taxes, insurance, and then any association fees or anything like that. You're going to divide it by that number. And then whatever that number is your DSCR. So your debt service coverage ratio. And then that's
Okay.
what the lenders are utilizing instead of your actual income to qualify you. They're utilizing how much that home would rent for and what that debt service coverage ratio is. And they have different targets that they want you to hit.
Okay, so debt service, simply put, is the amount of money that it costs to hold that home each month. What
Yep.
you have to
Yeah.
pay
So
for that.
essentially, yeah, it's just a ratio there. So like when we normally look at qualifications, we're looking at debt to income ratio, right? So we're looking at what your monthly payments are divided by your income. Now, instead of utilizing that ratio, we're flipping it over to the debt service coverage ratio and saying, if that home can support itself while it's being rented, then they're going to go ahead and lend on it, as long as everything falls in line with your qualifications as a buyer. So you just don't have to worry about having your personal income scrutinized or worried about the debt to income ratio anymore. It's just a different way to be able to lend on an investment property.
Okay, so that ratio coverage that you're speaking of, is it just has to be the same as it, or is there a different ratio that's needed?
Yeah. So the cool thing with it, being a mortgage broker, obviously we've got access to a bunch of different lenders, and the appetite out there is different depending on the lender. And so some of them, and actually one lender in particular that I work with, has a no ratio product. So what that means is it doesn't matter what that debt service coverage ratio comes in. If you're an experienced investor, they trust your decision making to buy a home that's going to debt service. So, in those scenarios, you're not shooting for that, right? Like, you're not aiming for a home that doesn't cover its own expenses. But if you come in and you're like, man, I know I can rent this house for $2,000, and then you order the appraisal, and then the market rent comes in at $1,600, and it doesn't cover the payment anymore. And you're like, man, that doesn't add up to me. And so, you would push forward with the purchase, and there'd be an opportunity to do it. So generally though, what they want to see there, the lowest bracket I see generally is like 0.75. So, in that same scenario, if your mortgage payment was $2,000, they'd want to see at least 1,600 on the rent schedule. And then to get into the better terms and the better opportunities for you, you're going to want to see it at least at 1%. So you're gonna want to see, if your mortgage payment total is going to be 2,000, you want to see it rent for at least 2,000. And then as you go up from there, 1.14 is kind of the next bracket there. So 1.15 and above, and then the next bracket starts at about 1.25. So those are just different brackets of qualification that, it gives the investor, the lender, more confidence in the debt service ratio if you're getting those kind of numbers.
Okay. And as far as the ratio, we've got that covered. But in terms of getting the loan, if you're an investor, what kind of qualifications do you need as the investor or the buyer in order to obtain the loan?
It's pretty straightforward, really. And it's tough to flip from, being residential and being mainly primary residences or the the agency stuff, the Fannie and Freddie stuff on the conventional side, being that type of a lender for so long. It kind of makes me feel like I'm not really looking at everything when I'm qualifying people for these loans, right? Because I'm used to having to scrutinize the income and having to go through all the paperwork. And the best thing about these loans is really, like, if you've got the down payment money and your scores are good enough, you're going to qualify depending on which house, right? It's all dependent on the house. So the asset becomes, or the investment property then becomes the main qualification. But when you back off to the buyer, I say good enough credit score, and that, that's going to be depending on which lender you end up choosing. Sometimes they're 640, sometimes they're 680, sometimes they're 700. And a lot of times what you'll see with the lenders is they'll have multiple tiers of products. Like we talked about with the ratios, they'll also have those tiers for credit score. And so there's not a whole lot, if you're 640 and above, we can probably find a place for it to fit. It just might take a couple $1,000s extra on the down payment. And generally you'll see those increments go up by 5% if you're below a certain bracket or something like that. So really, if the house is going to be able to debt service, they want to give you that loan. And so as long as your credit score is, not awful, we can generally find a home for it.
Gotcha. You did mention, the credit and throw out some numbers for the credit, and depending on how good your credit is kind of going to determine on what you can lend on. But you also mentioned the down payment, and what kind of down payment are we looking at in terms of, if you have really good credit and you find a house that meets that coverage ratio, where does the down payment start?
So first time investors, I know you brought that up, kind of starting, like people are having trouble getting started. So as a first time investor, it's going to be a little bit more expensive on the down payment side, because they're not going to, as a lender, they're not trusting your decision making as a first time investor, right? You've never done it before. You don't have a track record of showing that you can manage the properties, all of that stuff. So generally they're going to want to see a little more security, a little more safety on their side. So with a long-term rental situation, the top end is about 20% down. Most of them are 25% down as a first-time investor. If you're qualifying using short-term rental, then you're going to be in that 25 to 30% down payment range. And so it really just depends on where you're at. But experienced investors, we've got DSCR right now products that go up to 15% down. So they're out there. Obviously, there's rate adjustments on those, because as you go, with the lesser down payment, the risk gets higher for the lender to make sure. So, there's going to be a rate adjustment there as well. But the options are generally 15 to 30% down, and that's where they kind of settle in.
Okay. Now, with the down payment, we kind of got that range for it. And, a lot of investors, the main thing they want to do is to use OPM, which is another acronym that we throw around, other people's money. For the down payment, do they have to use their own verified cash, or are they able to source cash from another investor, or maybe be able to take out like a home equity line out of their current residence to use as a down payment? How does that go?
Yeah. So you kind of touched on a few different routes there. So I'll try to recoup those, because they're all kind of their own lane of what you said there. So you mentioned the other people's money. So utilizing like a private money loan. That's an opportunity. There are a few programs out there that we've got access to right now that don't really source any large deposits. So they just require, a 30-day bank statement with enough money in the bank statement to show that you've got the money there. Obviously, in certain scenarios, if they're seeing a name that is outside the purchase or something like that, they may go, hey, this looks like gift funds. Now we have to document it. So we got to be really careful about how you document those paths of the money. The private money loan, also, if you go institutional private money, which you're looking at more of like another bank lending you the money instead of an individual lending you the money on the private money side. A lot of the investors are okay with that because it's more easily documented and that kind of stuff. That being said, what they will want to see is generally at least 5 to 10% of your own money into the deal. But again, with the individual private money, if it's sent through your account and documented properly, sometimes they don't require sourcing on the backside. And so you're able to utilize that individual's private money for the down payment in a different route, right? Like you don't have to document it the same. And then you mentioned the HELOC. So this is a multi-step strategy, right? Is being able to utilize a HELOC on your primary residence or on another one of your investment properties to go buy another asset that's going to make more money. And so I'm actually doing this right now with 2 separate investors that we worked on the HELOC first. We got them their money, and then they went out shopping for that investment property. And it works really well. I mean, ultimately, you just want to make sure that your rent on the new place can either cover the cost of that, or you can pay off that HELOC aggressively. You don't want to get yourself underwater in a scenario like that. So you got to safely do it and very intelligently do it and make sure your numbers are in line before you're taking on that extra risk of the HELOC.
Yeah, it's a good point. That's the main thing that you got to worry about when investing is just make sure that you know your numbers and really play it safe with your numbers. On the investing side, never make an assumption like, hey, this could happen. You should have a good amount of space to play with in terms of the money that you're putting out and the return you're going to get. But if done properly, what you just said is that if somebody theoretically bought a house, 7-8 years ago when property values were not what they are right now, they could be in line to take out a home equity line or a home equity installment loan, and then use that as a portion or the down payment for a DSCR loan, be able to pick up a property, pretty much with very little to any money out of pocket, and then put a renter or tenant in there and have that tenant pay off the property for them, basically just giving them a free investment, it's a great long-term strategy.
Yeah. It's I mean, I'm seeing it in multiple directions. I've got a couple people right now as well that we're doing, everybody's kind of saying refis are dead. And it's really funny because refis are only dead for people that are, trying to save a couple $100 a month, right? You're not going to get if you bought it all in the last 4 years, 3 or 4 years, you've got a really low first mortgage interest rate. But if you've already paid off that loan, you can do a cash out refinance and take that money and go buy another house in cash if you wanted to. There's so many different multi-level extra strategies for investors to utilize other people's monies, like you said. And how do you see on your side? Are you seeing a lot of people utilizing lines of credit in that way, or are they just kind of tapping into it, or what are you seeing on the real estate side?
Yeah, so the ones that I've seen that are using those lines of credit, the home equity installment loans and HELOCs, they're out there. They're not abundant like they probably were a few years ago. But I think once you find the property, if you can get the right price on it, people don't want it. There's a lot of people who don't want to invest right now. But as long as you're finding the right deal at the right price and the numbers work, it doesn't matter what kind of time of the market it is. If the numbers make sense, if that property is going to cash flow long term for you, why wait? Just pick up a property now and kind of build your portfolio.
Yeah, and the other side of that too is we're still, I mean, in Florida we're spoiled, right? We're at a point of like 300,000 people moving here every year. We generally aren't really worried about the appreciation loss at this point, and it's plus we're the biggest market for foreign investors to come in and do it that, buying homes that way as well. So you're looking at a market that should hold value for a considerable amount of time, if not gain value, hopefully not. And I say hopefully not for health of the market like we did in 2020 or 21 and 22, where we gained 20% year over year both years. I don't really want to do that again. I think that's a little aggressive and not healthy for anybody. But you're in the Florida market. We're just looking at different ways of approaching it, because it's like, just get as much property as you can at this point. Like let's get out there, get some property that's cash flowing for you, and make sure the numbers work, and you can change your financial future very, very quickly. Like you said, with very little to no money out of pocket at all. So
yeah. And the thing is, real estate is still selling. I mean, there's houses selling every day. And even with the interest rates, I think the last time that I checked, yesterday, the average for a 30-year, it was like 7.05. And I'm sure that's, depending on, great credit, things like that. But in terms of the interest rate for the DSCR loan, kind of where do we stand when compared to a normal conventional loan that people would take out?
Yeah, and obviously those sources, like what you're saying there, the sources vary from place to place. Like Freddie Mac puts theirs out, Google puts theirs out. A couple different places put their data out, and they're always different. And so, we look at the averages as just simply that, right? It's just averages depending on where you get your information from. And with that, you're looking at right now, you're probably looking at an investment property. On a normal conventional, you're probably looking mid sevens, and possibly with a couple points to get that. The advantage of the DSCR piece, obviously you don't have to verify your income, so you're saving yourself a ton of time on paperwork. And really, like, these loans are funding in 7 days, and like, I'm not joking, because all you got to do is get an appraisal after the fact, right? You've already underwritten the borrower essentially, and all you got to do is get an appraisal and a couple documents. So the advantage of that is speed. The advantage of that is convenience, and then the rates aren't that bad either, right? Like I'm locking rates right now, like 7.75 to 8.5, depending on the scenario, what they're utilizing, and really the range is crazy. So putting a specific number on it is difficult to do, but the range, I mean, you're looking at between 7 and 9.5%, depending on the scenario, what your credit score is, how much down payment you're putting down, what you're using for qualification basis, what the DSCR is. So instead of looking at how much income you make, and just the credit score and that kind of stuff for a primary residence, we're looking at really what the scenario is based around the collateral. So what the house scenario is going to be at the end.
Yeah, and I mean, you say 7.5 to 9.5%, and people might think like that is a high rate, but if you haven't been into the investment side of real estate, if you're going to a hard money lender right now, if you're kind of new to the game, you're probably looking up around 12% interest, and you're also looking at about 4 points to pay up front for them to fund your deal. So, I mean, your interest rate is a lot lower than, what they would find with a hard money lender.
Yeah, and it's a long term, right? Like a hard money lender is not going to give you a 30-year term, right? And
No,
so
usually they're looking for a year, maybe two. They want to get their money back so they can reinvest it again and get paid those points up front. So, within that year or two time, you're going to have to figure out, what to do, how to, if you can refinance it or what. So you're a long-term, a long-term loan actually meets a lot of your needs. You're not having to go out and try to flip out that property to somewhere else within a year.
yeah, and you lock in your cost, right? Like with a private money lender, you know what your cost is for a year or two. You don't know what rates are going to do at that point. You're thinking, okay, let me take this high rate now so that in a year I don't have to worry, I can refi back into what the lower rates are going to be, right? Mm-hmm. But this locks in your investment costs for the most part. Obviously around here we have to deal with the insurance changes and the the property tax increases when you own an investment property, but for the mortgage side, it's going to lock it in. There are, variable options if you're interested in gambling a little bit, but most of them are right around that the same price as a 30-year fixed. So, the different terms on these are pretty much just like conventional, and they even sometimes go out to a 40-year option if you've got the right combination of down payment. So, generally, what that looks like is like 10 years interest only with 30 years amortized after that. So, as a cash flow perspective, if that's purely what you're looking for, you don't care about the amortization of the loan, the 40-year makes quite a bit of sense, right? You're going to save yourself the most money per month on the payment, which creates more cash flow for you on the backside. And if you're not planning on, selling, or if you're planning on selling it within 10 years, it makes perfect sense to even, to consider that 40-year option for that reason.
Yeah.
So it gives you that kind of flexibility of that.
All right. So that you can go anywhere from 15 to 30 to up to 40 years for a term using the DSCR.
Yep. Yeah. It's a pretty open, like I said, it's all really what the appetite is of the lender. And most of those lenders have that 40-year interest only option. And again, no income qualification to do it, it just blows my mind every time I say it. Like, we're writing loans again without the interest or without the verification of the income. But
yeah. Now with the obviously this is a investment loan only. You're not going to be able to get it for primary residence or anything like that. So being on the investment side, what kind of investment would this be used for in terms of, would it have to be a long-term rental? Could it be a short-term rental like a VRBO or Airbnb? Just kind of what are the options with the DSCR in terms of what type of investment you can buy?
Sure. So I'm going to say yes to all of those. We can utilize any of those as qualification purposes. Now, depending on if you're doing a refinance or purchase with the short-term rental, it can get a little sticky, because what they're going to do for a refinance is look backwards at your ability to produce the income. So if you've owned the property for at least a year, they'll look backwards at your records from Airbnb and Vrbo. They want printouts. They want to average the income across the months, so that they're going to use hard numbers that way in a refinance. And a purchase, we're going to utilize most of the lenders that utilize the short-term rental are using a program called AirDNA, and it's a commonly known program, website that's out there that you can pay to be a part of, a member of their setup, and being able to utilize that website to kind of find what averages are in the area, what averages are in the city, what averages are for that specific house. And so they'll look up the address, and I can get a qualification for a home address within 5 minutes, just texting the lender or emailing the lender and representative and going, hey, can you check this on AirDNA? They want to buy this one, let me know if it qualifies. And they'll spit back out a number, and they want to see, 1.25 or 1, and some of them, like I said, no ratio at all, if you've got the experience. So you can utilize any of those, but really the short-term rental, because it's a little bit on the newer side, as far as the numbers go, and they're really using kind of an estimate off of an aggregating website, that's generally going to be about 5% more on the down payment. So, that lender that I talked about that has the 15% down as the minimum, that's going to be on a long-term rental that does qualify, DSCR, that does have the ratio it needs. And then if you're going to go into the short-term rental for that same program, the minimum is going to be 20% down instead of 15. So that's just how they're offsetting their risk of using potential short-term rental by adding 5% to the down payment.
Gotcha. And so I kind of read between the lines there, when getting this type of loan, you actually, even though it's a rental loan, basically, or one that you have to have a tenant of some sort to pay off that mortgage, sounds like you don't have to have a tenant in place when you're purchasing the property. It does not have to currently be rented out at the time that you're purchasing, so they can see what the property is generating. You guys can actually go back and kind of run rental comps on it to see what type of rent that would get and base your decision off of that.
Yep. Yeah. So for the short-term rental, like I said, they'll use the AirDNA, which is basically a comp aggregator for the short-term rental. So they're going to go find the comparables of the short terms in the area and what it would rent for. The long-term side gets basically reliant on the appraiser to do the work. So when the appraiser goes in, he will find also other rental comps, and he'll aggregate that data and do what appraisers do and put it all together and find what they think that specific house would rent for, or roughly what it would rent for in this current market. And so that's the qualification piece, is being able to utilize the appraiser on the backside for the long-term rental. So long answer is yes, or short answer is no, you don't have to have a renter in there. And even if you're buying, if it's somebody's primary rental, or primary house that you're buying, they're moving out, you don't have to worry about that, because you're going to be able to get what an estimated rent would be, and then that's what you're going to qualify off of.
Okay, cool. So another question about the loan and kind of closing it. We got through the down payment, kind of what you need, and with every loan, there's closing costs that you have to pay, when you close on the property. With other loans such as FHA, conventional, if it's a primary residence or anything like that, you're actually allowed to negotiate for the seller to pick up some of your closing costs as concessions. I believe conventional is 3%, FHA you can go 6%. I believe that's still what it is.
Pretty close, yeah. Yeah, there's
Yeah,
some
so
variation there.
with the DSCR loan, are we able to negotiate that the seller will pay for any of those closing costs to kind of relieve the buyer of coming to the table with cash?
Yeah, yes. The short answer is yes. The long answer is the cool thing with these programs is a lot of it will mimic conventional guidelines. And so outside of the income piece, everything really is going to be, I can't say everything, but the majority of things are going to be right down the line with conventional guidelines. So on an investment property for Fannie Mae and Freddie Mac, you're allowed 2% of the purchase price. Most of the lenders we work with for DSCR will allow 2% of the purchase price towards the concessions or towards the closing costs from the seller as concessions. And, I know there's interesting programs out there right now, like the 2-1 buy down and all of that stuff. That stuff doesn't really apply in the investment world. And even in a conventional loan, it would be, and I'm not even actually going to say this without a clarification of I'm not 100% positive on this, but I don't think in the conventional world you'd be able to utilize a buy down on an investment property just because of the way that the guidelines read on that stuff. Because it's generally like, let's get more people into homes. Let's incentivize people to buy primary residences. That's been, if you look back over the last few years, that's been Fannie and Freddie's 100% drive is to get more people into primary residences. And you can see it based off of the moves that they've made with loan level pricing adjustments on second homes and all of that stuff. And it's because there's a shortage of housing out there. And so this is the alternative to using Fannie and Freddie backed loans that are basically saying, we don't want investors in the market. We want primary residences. Now these investors are coming out with these products and going, we love investors. Let's get them, let's have rent stabilization across the country. And let's allow people to buy houses without having to worry about it being rent controlled and all of that stuff. They're pushing for that stuff to get investors out there to be able to stabilize rental markets as well. So, that was a very grand picture of what's going on with Fannie and Freddie at this point. But, that you can just see it with their moves across the last few years that they really want to focus on primary houses instead of the investment loans and stuff. So.
Cool. Well, I mean, from everything that we talked about, it seems like a great loan and, a great tool for investors who, are looking to get into rental properties and maybe they don't have that relationship with hard money lenders or, don't want to overpay those hard money lenders, up front. So, I mean, is there a way to, I guess, how would be the best way to put this? I guess, is there a way that they would be able to consult you directly to get more information if they needed, any other questions on the DSCR loan, straight from the lender?
Yeah, wherever you're seeing this video, because we're gonna put it everywhere. We know that, right, Matt? We're gonna just put it on all the platforms. So wherever you're seeing the video, feel free to leave a comment if you got questions. I love interacting with that stuff. And Matt, I'm sure you're gonna put this stuff on yours as well. And so I encourage everybody to interact and ask the questions, right? Because there's a lot of stuff that we didn't cover that revolves around these loan products too, and we want to hear from the investors themselves. We want to hear from the people that want to utilize these programs to what your questions are so that we can make it a little bit more relevant for you. So yeah, feel free to just leave a comment or shoot us a direct message on any of the platforms. And I'm super excited about being able to roll this out and being able to kind of get this out to the masses because it is an underutilized product for sure. It is a growing product though. I was on a webinar a couple weeks ago and it was the same webinar. It was a DSCR webinar, and it was basically the same webinar that I was on a month before, just learning it and making sure I know all the ins and outs. And the first time I was on, he said, raise your hand if you've done a non-QM or a DSCR loan in the last 12 months. And about 20% of the people raised their hand. The following month, about 80% of the people in that webinar had raised their hand. So it's fast growing. It's becoming more readily available. I mean, even lenders like UWM have multiple levels of DSCR now. So it's becoming a very popular loan. With all the shortages in the market, these lenders are getting hungry again to be able to open up some more products that aren't traditional and being able to qualify more people to buy homes. So you're going to continue to see, if we still have these tight markets, you're going to continue to see lenders open up as much as they can, without the government stepping in and say, hey, you can't do that, because we don't want another 2008. Within the ability to repay and all of that stuff, they're going to really, really try to open up a lot of those products. So, investors and primary residences alike, you're going to start to see some interesting products that come to market to be able to allow more people to get into homes and more investors to buy properties to stabilize the rents and stuff like that. So I'm excited, and I appreciate you coming on with us today, and looking forward to doing a couple more of these, and maybe we can expand on some topics that people comment and ask questions about.
Yeah, man, I appreciate you having me on. It's been fun, and I'd like to get on here as much as possible and kind of talk back and forth with you, and kind of let people know about these products that are out there that they probably don't, never heard of or don't know about. That these investors are using, but maybe the person who's looking to get into investing right now, a lot of them are just kind of in the dark and they don't know, where to start. So I think, being able to come on here and talk to you and kind of explain some of these products to them, very beneficial.
Yeah, education is the most important for sure, and that's why I work with good people like you, because we always want to educate and make sure everybody knows what's going on. So I appreciate you, Matt. Everybody else, you have a good day. And then, like I said, if you got any questions for me or Matt, feel free to leave it in the comments, and we'll get back with you on an answer. So we'll see you soon.
All right. Thank you, Ryan.